Hello, investors. Thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today, I want to talk about Snowflake. Snowflake reported their results for Q4 22 2 weeks ago, but since then, the share price has been moving quite a lot. So I thought it was worthwhile kind of revisiting this investment thesis. So the stock, from everyone I talk to, remains a crowd favorite amongst investors. It's has a very strong and compelling narrative that I'll highlight for you in a moment. But all that being said, I contend that it doesn't make a lot of sense to buy this dip now. That you shouldn't be too eager to buy this dip. Um, so there's a lot that we need to go through here today, but essentially that this is a takeaway. That paying 55 billion market cap for this investment isn't worthwhile. So we're gonna go through all that and more. Yeah. So the stock in the past 3 months has sold off meaningfully. It's down 50%, and cheap can always get cheaper. That's the thing to remember. Cheap can always get cheaper. And sometimes we kind of look back and we kind of think ourselves, hey man, it's down like 50%. It's no way it's gonna just bounce back up. It's not necessarily gonna bounce back up. You have to think through that. And I really seriously believe that it doesn't make a lot of sense to buy this dip at this price. So 2 weeks ago, I wrote about Snowflake, and I said investing is never easy and investing is never obvious. You're always working off incomplete information as an outsider, attempting to make the best investment decision you can with information available at odds that leave you with an ample margin of safety. I fail to see how Snowflake offers investors enough margin of safety. And I know that investors would much rather stand behind the narrative of buy and hold forever rather than reassess their investment thesis. But you are left with a clear choice now. You can either reassess now or you can do so later at a low valuation. And if we rewind the clock slightly further back in August, way before the Snowflake share price started to melt, I said that at 42 times next year's revenues, for new shareholders, it's difficult to get very excited here. And since I wrote that in August, the stock is down approximately 40%. And I didn't have a crystal ball in August, and it's clear, obviously, nobody has a crystal ball, but I could see enough then, as I can see now, that paying 55 billion market cap for Snowflake isn't going to be a worthwhile investment. So there's a few things. The one thing is that revenue growth rates are pointing to decelerating. They're going to end this year up approximately 67%. Now, this figure is what management gives you. It doesn't account for the revenues that come from the professional service segment. But that side of the equation is only growing at 6% year over year. So it's actually a headwind. And that side of the business is the professional services, where they offer consulting services. It's really unprofitable. So nobody's investing in Snowflake for that. Everyone's investing in Snowflake because of its data platform. Okay, so just a few different things that I wanted to highlight for you. The other thing that I wanted to highlight is that when they reported their Q4 22 results 2 weeks ago, they only beat the top line by less than 3%. This is a stark departure from prior quarters. In prior quarters, Snowflake beat on the top line by mid to high single digits, and this time around it was like, whoa, we just kind of like slow down quite significantly. And I think that this is quite a telling thing. So Snowflake is a cloud-based platform, right? So the way it works is that the more customers upload data to it, the more valuable that data becomes. It feels like a moat, really. And what what Snowflake does is breaks down the data silos, so that as more and more customers embrace the platform, they're able to drive data-driven applications with that data. So it allows companies to really store at scale enormous amounts of data. And it does so by embracing the elasticity of the cloud. So it just allows companies to drive a lot of insights, and there's a lot of scalability that allows companies to drive through any workload. So there's a lot here. I mean, investors are really, totally blindfolded. There's a lot here to like about it. I mean, I get that. I seriously do get that. And any business that is able to have this kind of virtuous mode that as more companies use it, it becomes more valuable. Well, that works. That works really, really well. So I get that thesis. I really get that. But you have to take everything in a context because, investments don't trade in a vacuum. So here's the thing, right? So when the share price is going sideways or the share price is going up, nobody asks difficult questions, okay? When the share price starts to go down, people start to ask difficult questions from their investment. And what happens is that the buy side, the hedge funds, the pension funds, whatever, the people with the money, they call up and they start to speak to the sell side analyst. Why are you selling me the stock? You have a buy rating on it and the stock is falling. And for a little while, the sell side will come up with some kind of non-answers and kind of try and football around. But after a few more weeks, when things don't look all that better, they update their financial models for the new reality. And they start to issue a hold recommendation rather than a buy now recommendation. Now, in Wall Street parlance, a hold is similar to a sell, really. And other analysts say, hey, house XYZ has a hold on it, so we're gonna, we have to update our models because we don't want to be behind the curve for our own clients. So everyone starts to kind of update their models. And when the share prices go down, they kind of say, the share price is down because of, this has changed. So now the stock is worth less, and that's why we have a hold. So it kind of becomes a circular reasoning. I get that it's circular, but it is what it is, and ultimately, that's the game. You don't try and blame the game. You just try as best as you can to understand the rules and get on board. So the easiest angle that everyone's going to be picking out in the next several weeks is the fact that the business Snowflake, if we look out to approximately, let's say, to the end of 2023, on fiscal 2023, they're pointing to approximately 1% operating margins. Now, as you know, that's a non-GAAP figure that adds back all the stock-based compensation, which is a non-cash expense. The problem is, as the share price goes down, management was very happy because it had previously a lot of stock-based compensation, which was worth a lot. But as the share price starts to go down, they start to see themselves, as everyone else is doing, that stock-based compensation isn't worth that much. So you need to bolster it up with either some more dilution for the shareholders, or you actually start to put some cash behind that, and that becomes a part of that non-cash expense suddenly becoming a cash expense. And it starts to, at that point in time, everyone starts to think, oh, is this business really going to be that profitable? So that's the background here, and they're human as well, because they see that the value of their compensation is going down. They also had dreams for that, for that compensation package, and they're like, well, you have to reward me to retain me. Now, as I've been batting around a few times here, stocks don't trade in a vacuum. What made sense from the investment perspective this time last year doesn't necessarily make sense right now. The rules are always changing. And right now investors are thinking to themselves, is it really worthwhile me paying 27 times forward sales for a business that may or may not return to growing at 100% CAGR? And it becomes even more difficult when you think about the business that is barely even profitable. In last week's article, I said that the odds of this investment looks less than satisfactory. I believe that investors would do well to avoid buying more of this name. And yeah, it's basically just a repetition of what I said 2 weeks ago. I said then, and I say now, that it's, you can't make the case that if you buy the dip, everything's going to be okay. Because it will not bounce back in the near term. It doesn't look like it's going to be okay. And in the long term, we're all dead. So I'm starting to look towards other opportunities that I believe are more compelling right now. And whatever you decide, good luck and happy investing. I really hope that you figure this out. But if you want to find out the names that I'm buying right now, don't forget to check out my marketplace. It's called Deep Value Returns. I highlight for you what I'm buying. High quality, actionable investment insights right now. Thank you so much for listening. I'll see you next time. Bye bye.